Managerial Accounting, Planning and Control Flexible Budget Performance Report. Now that we've calculated the amounts for the flexible budget, what revenues and costs should have been for the actual level of production, we can begin calculating some variances. Now notice we got three columns here. Column 1 is the planning budget, column 3 is the flexible budget column, and column 2, the one in the middle, is going to be our activity variances. These are going to be the variances that are specifically related to the change in volume from what we planned to what actually happened. So we've already seen that in terms of units, we've got a 3,000 unit favorable activity variance. Now, what portion of the revenue difference between actual and plan is strictly due to activity? Well, column 3, our flexible budget amount, shows that at 23,000 units we should have had 920,000 in revenues, and the plan for 20,000 units was $800,000 of revenue. So the activity revenue variance is 120,000 favorable. 120,000 favorable. Now, what portion of the costs are strictly due to activity? Well, the variable cost of goods sold should have been 440,000 for 23,000 units. The planned amount was 360 for 20,000 units. So the portion of the cost difference on cost of goods sold that is strictly due to activity is 54,000. And that is, if you will, unfavorable because we naturally incurred more cost at a higher activity level than the standard called for. Now, notice the fixed overhead should not have changed due to activity. So there should never be an activity variance for fixed costs. Now, we also want to take a look at the selling and administrative costs. The variable selling and administrative costs were planned to be 30,000 at 20,000 units, but at 23,000 they should have been 34,500. So that is 4,500 additional costs that we incurred strictly because we produced more units. And it's unfavorable relative to the planning budget, but not necessarily a bad thing because we should have incurred more selling and administrative variable costs to achieve a higher level of sales. So overall, again, the fixed, no difference because total fixed costs should not change as activity changed. So overall, the activity variances, which is the difference between the planned cost and revenues and what the cost and revenue should have been for the actual level of activity, when we look at these overall, we've got a net $61,500 favorable variance due to activity. Okay, so that's good. While costs did go up because of the increase in activity, revenue also should have gone up. So we should have had a $61,500 favorable or increase in net operating income as a result of the increased activity. But as we know in looking at actual, that's not exactly what happened. So once again, we need to do more investigation, and we're going to add more columns to our flexible budget performance report to lead us towards answering the question, why wasn't net income what it should have been at this level of sales?